Hey there, fellow investors. Today, we're diving into the world of value investing, and I'm excited to share with you 6 essential metrics that can help you make smarter investment decisions. Whether you're a seasoned pro or just starting out, these key indicators will give you a solid foundation for evaluating stocks and spotting potential bargains in the market. Let's kick things off with a quick introduction to value investing. This strategy, popularized by legendary investors like Warren Buffett, focuses on finding stocks that are trading below their intrinsic value. The idea is to buy these undervalued gems and hold on to them until the market recognizes their true worth. It's like finding a designer handbag at a thrift store price. Who doesn't love a good deal, right? Now, before we jump into our 6 must-know metrics, I want to emphasize that successful value investing isn't just about crunching numbers. It requires patience, discipline, and a keen understanding of the businesses you're investing in. These metrics are tools to help guide your decision-making process, but they should always be used in conjunction with thorough research and analysis of the company's overall health and future prospects. All right, let's get started with our first metric, the price-to-earnings PE ratio. This is probably the most widely used valuation metric in the investing world, and for good reason. The PE ratio tells us how much investors are willing to pay for each dollar of a company's earnings. To calculate it, you simply divide the stock's current price by its earnings per share. For example, if a stock is trading at $50 and has earnings per share of $5, its PE ratio would be 10. This means investors are willing to pay $10 for every $1 of the company's earnings. Generally speaking, a lower PE ratio might indicate that a stock is undervalued, while a higher ratio could suggest it's overpriced. However, it's important to compare PE ratios within the same industry, as different sectors can have vastly different average PE ratios. Moving on to our second metric, the price-to-book (PB) ratio. This one's all about comparing a company's market value to its book value. The book value is essentially what would be left if the company liquidated all its assets and paid off all its debts. To calculate the PB ratio, you divide the stock's price by its book value per share. A PB ratio below 1 might indicate that a stock is undervalued, as it's trading for less than the company's net asset value. However, be cautious. A low PB ratio could also signal underlying problems with the company. I always make sure to dig deeper and understand why a stock might be trading below its book value before making any investment decisions. Next up, we have the dividend yield. This metric is particularly important for income-focused investors. The dividend yield tells us how much a company pays out in dividends each year relative to its stock price. To calculate it, you divide the annual dividend per share by the stock price. For example, if a stock is trading at $100 and pays an annual dividend of $3 per share, its dividend yield would be 3%. A higher yield can be attractive, but be wary of yields that seem too good to be true. They might not be sustainable in the long run. I always look at a company's dividend history and payout ratio to get a better sense of its ability to maintain or grow its dividends over time. Now let's talk about the debt-to-equity (DE) ratio. This metric gives us insight into a company's financial leverage and risk. To calculate it, you divide the company's total liabilities by its shareholder equity. A lower DE ratio generally indicates a more financially stable company, as it's less reliant on debt to fund its operations. However, it's important to note that optimal DE ratios can vary widely between industries. For example, capital-intensive industries like utilities or manufacturing might have higher DE ratios compared to tech companies. As always, it's crucial to compare a company's DE ratio to its industry peers for a more accurate assessment. Our fifth metric is free cash flow. This is a key indicator of a company's financial health and its ability to generate cash beyond its operating needs. To calculate FCF, you subtract capital expenditures from operating cash flow. A company with strong, consistent free cash flow is often better positioned to invest in growth, pay dividends, or buy back shares. I personally love looking at FCF because it's harder to manipulate than earnings and gives a clearer picture of a company's true profitability. When I see a company with growing FCF and a stock price that hasn't caught up, it often piques my interest as a potential value opportunity. Last but not least, we have the earnings growth rate. While value investing typically focuses on current valuation, it's equally important to consider a company's future potential. The earnings growth rate shows us how quickly a company's profits are increasing over time. A consistent, strong growth rate can indicate a company with a competitive advantage and good long-term prospects. When evaluating earnings growth, I like to look at both historical trends and future projections. It's also helpful to compare a company's growth rate to the overall industry growth rate to see if it's outperforming its peers. So there you have it, 6 essential metrics for value investing. Remember, these metrics are just the starting point. They should be used in combination with qualitative analysis, including understanding the company's business model, competitive position, and management quality. As we wrap up, I want to emphasize that value investing isn't about finding cheap stocks. It's about finding stocks that are trading below their intrinsic value. It requires patience, discipline, and a willingness to go against the crowd. But when done right, it can lead to substantial long-term returns. I hope you found this video helpful in your investing journey. If you did, please give it a thumbs up. And don't forget to subscribe to our channel for more investing tips and insights. Hit that notification bell to stay updated on our latest videos. And hey, drop a comment below to let me know which of these metrics you find most useful in your own investing strategy. Until next time, happy investing.